ladies and gentlemen. I'm delighted to see you all here. I look forward to what I think is going to be an extremely interesting afternoon, certainly an instructive and educational one. And of course, we do need instruction and education on the questions before us today, which are international finance and budgetary politics and the bloody crossroads where they meet. These things make an immense difference to all our lives, the difference between whether we have a job or not, whether our savings are protected so that we live comfortably in retirement, and these days, whether we'll be able to heat our bedrooms this coming winter. But that doesn't always seem to be the case. Many decisions of central banks take place in privacy, and financial journalism doesn't always prioritize truth and understanding over sensation and panic. Just lately, we've been focused on the travails of the British pound sterling, which fell sharply after a recent British budget and brought about the collapse of one Conservative government there and its replacement by another Conservative government, this one led by a financier, Rishi Sunak, who has a personal family fortune of $800 million. We'll see if his conduct of the UK's finances does as well for the average British family. But while there's been some Schadenfreude, that's German for gloating, in the EU over Britain's financial problems and the shrinking pound, after all, Brexit and all that still casts its shadow. Justified or not, however, the EU has got to consider its own currency and financial problems. If the pound fell against the dollar, as it did sharply, the euro fell at least as badly. In fact, obviously, the EU faces quite considerable financial and currency and other economic problems. The sovereign debt of 4 countries, Germany, France, Italy, and Spain, equals 70% of all EU debts. We're used to thinking of Mediterranean Europe as the countries in trouble, but trouble is no longer confined to them. Due to years of monetary and fiscal policy that is questionable, at least, money is flowing out of the EU. Traders are shorting EU bonds. The costs of debt financing increase. Inflation rises, due in part, but not solely, to the war in Ukraine, but also due to the overhanging debts from the COVID-19 and lockdowns. In these circumstances, what is the future of the euro? The currency that's been on a downward trajectory for about a year and is now below the US dollar. How will this impact smaller countries like the Czech Republic, Croatia, Hungary, and Poland, which are still using their own currencies? In short, is there going to be a coming Eurozone crisis? And if so, what will its characteristics be? We're very fortunate to have 4 distinguished speakers to address this question. Stephen Bartulica, who's a member of the European Parliament, and I should say an old friend of the Danube Institute. We've done several things together. It's nice to welcome you here, Stephen. Is a professor of political philosophy at the Catholic University of Croatia in Zagreb. He's the founder and president of the Center for the Renewal of Culture, a Croatian NGO. Welcome here. Second speaker is Mr. John Prout, a practitioner of finance in the markets, who spent 22 years as an investment banker in the City of London and then Paris, and then 10 years in Monaco in asset management. He's held a number of board and committee positions in organizations like the New York International Treasury Club, the Chicago Mercantile Exchange, and the Philadelphia Stock Exchange. So we have someone who is, so to speak, knowledgeable about the sharp end of finance. And then our third speaker will be Dr. Neven Vidakovic, the CEO of Loci Trading and adjunct assistant professor of economics at the University of Maribor in Slovenia. He is the co-author and author of numerous books on banking, exchange rate regimes, and monetary and credit analysis. And our final speaker is Zabol Pastor, the associate professor at the University of Public Service in Budapest here, and a senior researcher at the Economic Research Foundation. I think we have four knowledgeable and talented speakers. I think we are in for an intellectual treat. Therefore, it delights me to invite Stephen Bartulica to address us. Thank you.
Thank you very much, John, for that kind invitation. I'm delighted to be back in Budapest, and I want to thank you and Melissa for the kind invitation to join you this evening. One small correction from the generous introduction. I'm a member of the Croatian Parliament, not the European Parliament. I wish I had the salary of European Parliament representatives, but I don't. I represent just poor Croatia for the time being. So it's a very timely subject this evening. You mentioned countries that haven't joined the euro up till now. Croatia will be removed from that list, I'm sad to say, on January 1st. So the current government has as one of its top priorities Croatia joining the Eurozone, and this will happen effectively on January 1. I've been quite critical about this in my public remarks for some time, and I'll try to outline some of the reasons for my skepticism here. I'll try to finish in about 15 minutes. I'm not an economist, so that's just for full disclosure. I teach political philosophy and courses dealing with the history of Western civilization, but I have followed the trajectory of the euro since it was introduced in Europe. I was actually serving as a diplomat in Germany at the time when the Germans were relinquishing the Deutsche Mark for the euro. And there was some skepticism at the time in Germany from the beginning. But it was one of the main priorities. I would remind you all of Helmut Kohl at the time. He saw it as a way of binding a newly unified Germany to Europe and ensuring that Germany's trading partners could not gain advantages over German products by devaluing their currencies. Now, I think in many ways, Kohl was correct. Looking back over the past 20 years, it's generally been a good deal for Germany and for the strongest economies in the euro area, I would say. This includes the Netherlands, other economies that are high export, very competitive economies. The euro has not been an obstacle to strong economic growth. The story has been quite different for economies in Southern Europe. And I would include my own country in this group. We're soon to join the euro, and my view is that instead of implementing more difficult reforms, structural reforms, changing the public health system, reforming the pension system, bringing down public spending, the government, instead of doing that, which is more perhaps a difficult task, it's decided to introduce the euro as a new measure that's designed to help our economy. The public opinion polls in Croatia are mixed. I would say established opinion, the conventional wisdom among elites, people who are in mainstream political parties and are talking heads on television, more or less are advocating for the euro. The common person on the streets, I would say, is much more skeptical. And there was a discussion last year about perhaps holding a referendum on the currency, and the government was very much opposed to this. The main argument being that when Croatia joined the European Union in 2013, it had already at that time agreed to eventually introduce the euro as its currency. So the government was basically arguing that it's already a commitment that Croatia has assumed, and that there's no point in asking the people what they think about this. So that was a convenient, I would say, way out of this discussion of a possible referendum. It was not to be, and so we're set to join. And like I said, I think our economy has not been reformed to the extent that we are competitive enough to gain benefits from the euro. I'm afraid that it could be an obstacle to our growth. It's complicated. Most of our trade is done within the euro area, but I'm afraid that this harmonization that big countries, including Germany, are pushing for will be a major price to pay. This loss of the small monetary sovereignty that we've had up till now will be gone for good. And this is a serious political question. When Germans advocate for harmonization, they basically want fiscal and tax policy to be harmonized to the extent that they control more or less the conditions within the Eurozone. So this small space allowing for countries to compete with each other and perhaps attract foreign investment, keep taxes low, and so on. This possibility will become, I would say, more difficult to achieve for Croatia in the future once we join. And that's a worry for me. I represent a new conservative party called the Homeland Movement, Domovinski Pokret in Croatian. And we're very skeptical and cautious when looking at, generally the centralization of power in Brussels and in institutions outside of Croatia, far from the eyes and ears of the average, citizen. I remember when the Greek bailout was a major topic of discussion from the last Euro crisis. The government in Slovakia actually fell, and they had early elections because Slovakia was opposed to paying into this bailout fund. And I was doing research on this issue. One of the main reasons, in my view, Greece has not been allowed to leave the Eurozone, even though it's been, in a way, a source of many problems from the beginning, is that the Greek debt largely is owned by French and German banks. Huge amounts of money owned by French and German banks, and it's much easier and feasible for German and French politicians to lobby for a bailout fund instead of allowing a uncompetitive country to leave the common currency area and open the possibility for these banks to lose huge sums of money and perhaps go bankrupt. So that's the political landscape, that all of the European citizens involved in the euro are asked from time to time to bail out problem countries. And this is becoming, I'm afraid, a plausible scenario for countries that are even bigger than Greece. Italy, for example. So what happens if Italy needs a bailout? How much will that cost? In the Croatian public debate, this has not even been mentioned as a possible risk of joining the euro, that perhaps our government, our citizens will be asked to pay into a bailout fund designed to help a struggling economy that's not ours. And so there's precedent for this. As I said, it could happen again. And my main worry is that this promise of convergence, something that economists were promising from the very beginning, that the common currency would bring this convergence effect and would raise the standard of living in poor economies and bring them closer to the more developed competitive economies. This has not happened, in fact. This has not happened. And so we have more or less countries like Portugal, Italy, Greece struggling on the verge of recession for extended periods of time. They have very low rates of growth. And the euro area in general, compared to the US, for example, if we look at over the last 15 to 20 years, has struggled. So there are lower growth rates than in the United States. Now, the economists have, I'm sure, better explanations for this than what I can offer, but that's a reality, that it has not allowed all the countries involved to grow in a faster way at higher rates than they were before. And so in a way, you could say that's a clear failure and something that has not transpired but was promised at the time. So basically, I see it as more or less a tool for deeper political integration. It's clear once you join the euro, it's almost impossible to leave. So this monetary sovereignty is relinquished for good. That's a serious issue. And for governments, our current government included, the Prime Minister is an enthusiastic Eurocrat. He spent much of his career trying to get Croatia into the European Union, working as a diplomat in Brussels. And so I can understand his way of thinking. But for the average person living in Croatia, I think it will not yield benefits. I'm afraid that for our companies, it will be difficult, even more difficult, to compete with the more competitive. And we're losing this small lever that we've had up till now. We have not devalued the kuna since it's been, linked to the euro for some time now. So we've had a fixed currency exchange rate for some time, and the economy, it's growing, but I would say not fast enough. And so one of the results of this, of Croatia not pushing through reforms that I think were long overdue, is that we're losing our population. And that's a general problem in Europe. Low reproductive rates, a declining population, an aging population. I read just recently that the largest employer lobbying group in Germany is worried about the pension system in Germany collapsing. It's facing collapse. And they're warning about this. They're saying this publicly. So we have a demographic crisis generally. We have economies with their welfare state models that are very expensive, relying more and more on migrant workers. Croatia will soon be part of this group, I'm afraid, because so much of our working population has left the country in the last 10 years. We've lost nearly 10% of our population since 2011. The new census figures just came out. So there's a huge price for not implementing reforms and having an uncompetitive economy. And my point is that introducing the euro will not change any of this. The average person, when he's asked on the street, looks to Slovenia. Slovenia introduced the euro many years ago, and Slovenes were complaining from the very beginning that it caused price increases on many projects. That's what they saw immediately. That was an obvious effect, that things became more expensive, not less expensive. And that's how the average Croatian, I would say, sees this now. They're very worried. We have inflation already now, and people are worried that things will become even more expensive after January 1. And that's probably, this skepticism is one of the reasons the government was very much determined to avoid holding a referendum on this issue. There's generally today in Europe this view among elites that it's not good to allow the people to have more of a say. And I think that's a big problem, actually, to be honest. I think we all have in Central Europe the very harmful legacy of communism that still lingers. Many of the media elites, the people still in academia in Croatia, in our political environment, come from the old communist system. They didn't just disappear. They retained their positions of power. And they would prefer the people not have a voice. They're very much, I would say, inclined to follow the lead of Brussels instead of listening to the worries of their own population. And I think that's a pattern in many countries in Central and Eastern Europe. This, I would say, estrangement from the average person and kind of a servile, I would describe it as a servile attitude in Brussels. Too willing to follow the lead of bureaucrats, or you could describe many of the people in the European Commission as has been politicians, failed politicians who remain powerful through their positions in Brussels, but many of them failed as national leaders in their own countries, I'm afraid. And so I would agree with many critics who say that Europe is being led today by people who are not fit to lead, who are incompetent, weak, and driving the continent into a very dangerous direction. That's my own view. And so Croatia, I think, should wake up, should take a more critical approach to what's happening around us, maybe look to countries like Poland and Hungary that, in my view, have more self-confidence in pushing back and contradicting the conventional wisdom in Brussels. So I look forward to the discussion. Thank you.
Can you?
Yes,
you can. Thanks. Sim, before you go back, I'd just like to ask you one question, as I will do with the other speakers, and that is, you've just given us a very interesting political analysis of the situation of a country which may adopt the euro. Now, most people, I think, will remember that one of the countries which suffered quite considerably as a result of being in the euro at the time following the 2008 financial crisis was Ireland. And Ireland found itself in exactly the position you were describing, as having to pay. The Irish taxpayers paid a very large chunk of debts because of the collapse of Irish banks. And that occurred because there were other countries which would have suffered if the banks had not been bailed out by the Irish taxpayer. As I say, it was a very severe bailout on the backs of the Irish taxpayer. It was a very significant loss of wealth. Now, that succeeded extraordinarily well because the Irish population is perhaps the most pro-EU population in the whole of Europe. And there was a kind of pride in the sacrifice that Irish people had made to bail out the Irish banks and to bail out Europe, in effect. And now, let me ask you this. In the event that your taxpayers found themselves on the hook in a similar situation for significant debts, what, in your view, would be the reaction of the ordinary taxpayer? Well, the popular reaction in your country, would it be as, well, it wasn't even passive, I was about to say passive, it was an active support on the part of the Irish. What, in your view, would be the reaction of the people in Croatia?
Much different, I think, much different. So the Croatian mood, I would describe, they're not enthusiastic about the euro. Since we've joined the European Union in July of 2013, we've had a demographic collapse. So one of the things that I bring up is that Croatia, because we have public education through high school, through university, in many ways, our taxpayers are subsidizing now, and for years now, qualified workers, highly educated workers, doctors, engineers, many of them who, after they get a free education or a subsidized education in Croatia, go elsewhere and work to Germany, Austria. So it's been a very good deal for Germany. Does that make sense for Croatia? No. And since we've joined Europe, I would say there's been many benefits, but many of the average people looking at their standard of living have not seen tangible improvement. And so there's this, on one side, demographic collapse, and on the other, skepticism about how good it is for the average person in Croatia, because we're still sadly at the lower end of most of these rankings in Europe. So I would say, because there's relative low enthusiasm, if there were a crisis and the taxpayers would be asked to finance a bailout, it would be a huge political problem. It It would be a huge political problem. And I go back to this question of sovereignty. Being in Hungary, it's good to remind the audience, Croatia in the in the medieval period, we lost our political sovereignty in 1102 when the Croatian nobility recognized the Hungarian king in 1102. And 800 years later, in the 20th century, we were still not a sovereign country. We were, after World War I, no longer part of the Austro-Hungarian Empire, and things got actually worse because we were ruled from Belgrade instead of Vienna. So things have just gotten worse for Croatia in the last 100 years, and that's why sovereignty, national sovereignty, is such a sensitive issue for us. And the people are not, I think, convinced from the arguments they've heard, offered by politicians, that this is a win-win. I think deep down there's this anxiety that things will be difficult. They see that in places like in Greece and Italy, the euro has not caused high growth, but it's more or less been, you could say, one of the reasons for these countries to lag behind, I would say. So, like I said, it's easier for a government to introduce the euro than to push through a change in the health or pension system. And so politically, I can understand why our prime minister has decided to do this, but I think he has not convinced the public that it's in their interest. He has the elite opinion backing him, but I don't think he has won the hearts and minds of the majority of the population. That's my own sense. And so if there were a crisis, like I said, I think it would be a huge political problem in Croatia, because there isn't this sense of pride that exists perhaps in Ireland. Ireland joined the EU much earlier, has had much more, I would say, a greater benefit from all the structural funds, from all the EU funding, the redistribution of money going through these schemes in Brussels. And so we're the latest member, and if things were to go south, it would create a huge, huge problem in Croatia.
Thank you very much indeed, Stephen. John, could I ask you to...
Sure. Okay, as you can hopefully see in big letters, we're going to start with where are we now, and you better fasten your seatbelt because I'm going to go bouncing around because all these things are interconnected. So GDP, if we take a look at this, you'll see up at the top that basically the growth is fairly limited. And on the bottom, you see the inflation, which has been rising well above that black line on the bottom, which says ECB 2% target. So look, I have to double check it's the right slide. So growth, third quarter just came in for the European Union. It was up 0.2 from the previous quarter, and it's running 2.1, 2.4%, depending on if you're looking at the Eurozone or the European Union year on year. The United States came out much stronger, 2.66% for the third quarter, but that's actually not real in the sense that exports accounted for 2.77% of third quarter GDP. So if you adjust for that, actually the US GDP was negative for the third quarter. And don't forget that for the previous 2 quarters, we've been running at a slight negative number, which officially would say the US is in recession. China itself is obviously much higher growth, but with zero COVID in place, it's a bit dubious as to whether that will revert back to the good old numbers. Inflation. So people are asking, have we peaked? Are we just starting? And with the Eurozone, we've just had a record set prices, 10.7% in the Eurozone. Germany was much higher at 11.6 versus the median of European countries at 10.9. Goldman Sachs even warned about a possible 22% inflation rate in the UK if gas prices cannot be held in check. And one of the things that hopefully we'll discuss later will be the second order effects that are still coming through from the supply side shocks, the logistics logjams that are still causing issues despite a slowdown in demand that we're seeing in various places. US inflation, if you look at the PCEPI, which is what the Federal Reserve looks at rather than the CPI as far as an indicator of inflationary pressures, was up 6.2% from a year ago. There are some measures that are showing potential declines in the US inflation. And I hope you could read some of the figures, but you can see that used car sales are going down, gasoline up at the top in the middle is going down, while meats, electricity, food at home, and new vehicles are not going down. Euro annual inflation, you can see how much we've taken off since late 2020. And you can, I don't know if you could see the small subcategories, which ones have gone up. Energy, of course, being the obvious culprit for the big increase. So where are we now as far as debt is concerned? Have we reached our limit? World GDP this year, $104 trillion. People do not realize that global debt, and this is all debt, this is government debt, household debt, corporate debt, all debt totals over $300 trillion. So we basically have almost 300% of world GDP as far as the debt level is concerned. If we look at only the sovereign debt, the government debt, it's $72 trillion, representing about 95% of GDP. And looking at the Eurozone as of the second quarter, because third quarter is not yet available, we have debt at 85% of GDP, and for the Eurozone, higher at 94%. You'll see the breakdown by some of the countries that I've selected. Hungary is noticeably, of course, better than Italy, Spain, and France. And for reference, I put the US. So here's the dilemma. We're raising rates. The ECB is raising rates to fight inflation. And yet, an indebted country like Italy, the higher the interest that they have to pay, the more investors are going to look and be concerned. If rates are going up and you're looking at lending to Germany, you're going to have less concern than you would to Italy. So people in the markets watch what we call the BTP Bund spread, which is the spread between the yield of the Italian 10-year government bond and the yield of the equivalent 10-year for the German bond. And both are government bonds. So I think, 2 weeks ago, we had the crisis where we had that spread go out to 261 basis points, meaning Italy was paying 2.61% more to borrow 10-year money than Germany. Today, that rate went down to, I think, about 215 to 211. So we've had some calmness coming back into the market, and I think that's only because in 45 minutes we get the Federal Reserve coming out with its interest rate hike and press conference, which may make a change in what I'm just saying. So the ECB has decided that there is an importance to maintaining a relationship that does not get out of whack between the Italian and the German government bond market in particular, but in principle, all the different countries in the Eurozone. And why is that? Why are they willing to spend billions and billions of dollars to prevent that? Well, because on one hand, as an American, I would say, well, if New York City, which it did back in the 70s, couldn't raise money because it was being mismanaged and they had to pay some outrageously high interest rate, let that happen and let the government reform itself until it convinces investors that it can borrow wisely. That is not being done That's not the policy of Brussels. So they are going to be willing to spend billions of dollars. And I believe the main reason, and we could perhaps discuss this later, is that should Italian interest rates be allowed to go up to where the market would dictate, it's very possible that the Italian banking system would fail. And then that requires a bailout, which is a different story altogether. Okay, moving on to fixed income. Well, I sort of already started to address that with regard to the BTP Bund spread. We also had something that was never done in history, or at least since I think the 30s, which is the German yield curve for the government bond market went inverted. And that again came back to flat yield curve, which that was being inverted is a sign of stress. It's now flat, which means that the 10-year yield and the 30-year yield is approximately the same. So a lot of it's going to depend upon how the US is going to react tonight and over the next few months, and how the inflation numbers come out, which will then impact the euro, which then could impact the bond markets in Europe. Here you see the inflation rate versus the interest rate. It's clear that in order to control a 10% inflation rate, 2% interest rates, or 3%, or 4%, or even 6% is not going to do it. So the outlook for the euro currency is not particularly great. On the foreign exchange, I think we just referred to it. One might argue, at least the markets, that a strong dollar is not good for the world, and because it puts pressures on emerging markets who have to take their goods and sell them and and pay more for the dollars that they need to pay for dollar debt or for dollar-denominated commodities like oil, if they're not oil independent. And of course, it hasn't helped the EU. On the commodity side, I would just point out an article that everyone should read by Zoltán Pozsár, who is of Hungarian birth, who works for Credit Suisse in New York or London, I can't remember which, who did a study showing that in Germany, $20 billion of energy is supporting $200 billion of value, and he's referring to the chemicals and steel industries of Germany. And that kind of leverage is, of course, imploding because of the high cost of energy that is being now paid. So how did we get here? Basically, for 4 decades, we've had low inflation, low interest rates, free trade, globalization, world peace, sort of, and now this trend is reversing. So people like to refer to the 3 Ds, demographics, disruptive technology, and debt. So let's go right into that. Demographics. We have the largest post-war generation in America, the baby boomers, 75 million, that produced the biggest economic growth of this century. They had exposure to disruptive technologies, phones, TVs, PCs, and the internet. And in order to finance this growth, both the public sector, in terms of building up an infrastructure as the baby boomers moved out to the suburbs, bought homes, refrigerators, cars, etc., and corporations to take advantage of the low, easy credit environment, started the growth boom in finance. Then we had something which is more my background when I started in the late 70s with the birth of the Eurodollar, not the birth of the Eurodollar, but the birth of floating exchange rates. Nixon had several years earlier gone off the gold standard in 1971, and we had the beginnings of globalization of finance. So that, over the next 2 decades, turned into high-risk lending, exotic. Someone described the panoply of credit instruments as a zoo of CDOs, CDO squared, CLOs, CFOs, all these fancy alphabet soup instruments. Some of you may remember from The Big Short, the movie about this, the CDO squareds and so forth. But that led to the abuse and to the financial crisis of 2008. That brought an end to a multi-decade expansion of credit. And it's a little hard for people to understand because they think the financial crisis came out of the subprime crisis. It didn't come from the subprime. It came because of a shortage of collateral. And this is important because of the context of what's happening in Italy and Italian bonds. So with the growth of the derivatives market, which I don't know if I have on this slide or it's the next, we had $600 trillion of notional derivatives around the time of the financial crisis. 600 trillion, almost a quadrillion, if you multiplied it by 30%. These derivatives required collateral to support the transaction. So what is collateral? Collateral is, the number one collateral is US Treasury bonds. When you buy stock and you buy it on margin, they ask you to put up collateral. So you'll put up cash. Some people put up Treasury bonds. So when you leverage, you're putting up collateral. And there are many forms of collateral. So during the financial crisis, you had all of the explosion of credit, all these different instruments, structured products, vehicles, et cetera, in all these different jurisdictions, and they were all leveraged. And there was collateral being put to support that. So Goldman Sachs would say, I want you to put up X amount of collateral. So you would put up a treasury bond, except somebody else would put up a subprime AAA rated tranche because Moody's was saying it was AAA, or someone would be putting up Italian government bonds, which, gee, this is the Eurozone, it's just as good as Germany. And so the support behind all of the derivatives was the collateral. And when subprime and certain other types of collateral were no longer desirable because they happened to be issued by Lehman Brothers or Bear Stearns, what happened was a cascade domino effect where, okay, sorry, don't give me those Lehman bonds, I want US Treasuries instead. I want better collateral. So the financial crisis was triggered by a shortage of collateral, which threatened to basically implode the whole financial system, which is why you saw the steps that were taken. And given that today the amount of outstanding derivatives hasn't changed, and we know for a fact that Italian government bonds are also being used as collateral, even to support US dollar investments out of Hong Kong, for example, this is something that people do worry about. So I think the point I wanted to make here is if you have global debt of 300 trillion and GDP or wealth of 100, and we, over the period from 2007, which I think is in the previous slide, basically we increased GDP by 50 trillion between 2007 and 2022, and we borrowed 200 trillion to do it. What's going to happen with 150 trillion that we owe? And this is going to be the question at the end of how do you basically pay that back? Because debt can only be repaid, defaulted, or inflated away. And when we say default, Wall Street never defaults, it's restructure, but it's the same thing. This gives you a little perspective on what I was just talking about in terms of the global debt between households, governments. So, what do we see for 2023? I think I will stop in a minute to basically allow the panel to sort of talk. However, I would just highlight energy independence as the biggest challenge for Europe, followed by the food crisis, which then, let's not forget about the structural unemployment, which has been a challenge for Europe for generations. And the last note I would like just to point out, money is not printed by central banks. Money is not created by central banks. Money is only created by commercial banks when they make a loan. And money gets destroyed when that loan gets paid back. And since the financial crisis, banks have pulled back logically because they almost went bankrupt, and some of them did. And so all the banks said, wait a second, we're not going to be doing this risky stuff, and they pulled back. But pulling back means they are more strict on lending, so the credit growth since the financial crisis has significantly moderated. And that hasn't been enough to keep growth going, which is why you've seen the growth numbers low. And it also begs the question of what's the solution to the $150 trillion problem, which I would dare say is austerity. Thank you very much.
Thank you. John, can you stay there for a second? While I think I have to say that's a somewhat pessimistic outlook you've given us. And my question is it pessimistic enough? And the reason I ask that is, I imagine that part of the reason why the debt inflated so dramatically as opposed to the rate of economic growth in the period you were describing is because, among other things, we ran up huge debts. The entire Western world ran up huge debts dealing with COVID, closing down their economies and paying people not to work, and developing various schemes to make life more livable during this period, although also to make life less livable, I would have to say. Now, if we want to really look forward to a better future, surely we have in total to start paying down that debt rather than adding to it. And the latest figure I saw earlier this week from the International Energy Association, I think there are several similarly named bodies, but this is very significant bodies, said that if the West is going to continue developing on the road to net zero, its present spending, which is something like, I think 599 million annually, will have to go up to 599 billion, will have to go up to an astounding figure of 1.3 trillion every year between now and 2030, I think, or possibly slightly later, 35. And now that is a huge addition to collective debt for the countries of the whole world, but in fact mainly Western countries. How do you think we are going, if we go forward to 2030 or to 2035, if you look back, what are you going to say happened as a result of our continuing to spend in that way? Can we continue to do it, therefore?
No, I don't think we can continue, and I don't think it will happen. It's one thing for politicians to say we need to do this and that when interest rates are at zero or close to zero. But when interest rates are at these levels, you can't say that. Plus, you'll get a revolt by the bond markets like the British saw when Truss tried to pass that passage of tax cuts and spending. It was a complete disaster and a potential meltdown for the British pension fund system that was risking a loss of $1.5 trillion. So I think you will see that kind of revolt, perhaps first in Italy. I'd be curious what others have to say, but we will see that kind of revolt. So I don't expect I think the green agendas have to be modified. It's very clear that there's got to be an adjustment to reality.
Thank you very much indeed.
Several things. I have been incredibly blessed with my previous two speakers because they have made two incredibly key points, which basically I'm going to go much deeper into. So number one point is the great lie. And the great lie is what my good friend, Professor Bartulica, said, the convergence. So if you do not have Kansas converging with New York, you will never have Croatia converging with Germany. The second thing is what you have just heard about the whole macro structure. See, I have been presented, which I like, and you will get that, as a professor of monetary policy. But on the flip side, I'm also a hedge fund trader. I trade my own money, and I'm a CEO of a proprietary trading company. So you will get two lectures here. You will get a hedge fund lecture and a macro professor lecture. The deal is, the way we call you people, we call you civilians. And the reason we call you civilians, because you exist in this world, which might be appropriately called the Matrix, where you wake up and you do all your stuff, you go to work and all that. But in reality is, we basically make it possible. People like me, people like my predecessor who has explained to you the way financial markets work. Now, every morning, a person like me wakes up and asks himself an incredibly simple question. Is it more profitable for me today to support the existing financial structure or to smash it and make money? Because that's what it is. It's just money. Nothing there. Now, if in the process of smashing, some Luigi or Gabor or Ivan or Hans loses his house and whatever, that's not my problem. You know whose problem that is? The people you have elected. So I have had what is known as the Apocalypse Lecture. Now, in this lecture, I have made a bold statement that there are no more futures. There's only one future. And this was at the Hayek Institute in Vienna. And if you go either on Hayek's channel or on my channel, you listen to it, you don't have to watch it. The video quality is rather dark. But if you go and watch that, you will see that what I have predicted to some extent has already occurred. So here's what we're going to do today. I will do two things. One, I will give you a short rundown of the lecture, and then I'm going to tell you how to solve everything. But there will be a small epilogue, just for fun. So if you look at, not mine, but the official fiscal sustainability report, Europe is fiscally unstable. This is not me. This is European Union. So what we have basically, and this is a brief rundown of the lecture, here's what's going on. On October 30th, 2021, Christine Lagarde said that ECB has looked deep into their souls. And they have concluded there's no inflation. Inflation transitory. Now keep in mind, this is the same woman that last week said that this highly unpredictable inflation has simply occurred. Now, at this time, here's what she basically said. She basically said that Europe is up for grabs. That you can do to Europe whatever you want. That Europe is going to be a huge factory of money. So, what everyone like me, here's when I realized that things are really genuinely bad. After this speech, I came up with a plan how to financially destabilize Europe. And I called my friend in Chicago who runs a hedge fund, and I said, what are you up to? And he says, well, there's nothing in the US bond market. We're just going to short everything European. And then I called my friend in Hong Kong and I said, well, what are you doing? And he said, well, there's nothing in the Hong Kong. We're just going to short European bonds. And when you have two people from Chicago and Hong Kong who run hedge funds tell you they're going to move aggressively into shorting bonds, imagine what Goldman Sachs has already done. So here's how you do it, right? You need the words not to match the data. And this is what our Mr. Sullivan knows, that in 92, the British governor was saying one thing and the data was saying the other thing. Then what you need to design the best way to attack a country. And this is where a previous lecture comes in. You don't need to short Italian bonds. Very few people actually short Italian bonds. It's hard to trade cash bonds. So you just use futures, and they give you leverage. So for example, if you want to short 100,000 euros of German bonds, you just need 2,000 euros. That's a 50 to 1. So if you want to short 50 million, well, do the math. Then what you genuinely need is more data and more lies. And this is what we have been listening from the European Central Bank for last year. I mean, remember, inflation transitory. Then in March, Christine Lagarde said, well, there's no point. Inflation in US is different than inflation in EU. Then she said there's no point in raising interest rates because, it's not going to work. Well, in the meantime, you basically see that in a June ECB meeting and the aftermath, when the ECB explicitly stated how they will defend the yield curve spread, the bond market collapsed. And that was the second stage of the attack. The first one was in March. Now, what my predecessor said, and I don't mean this in a derogatory way in any way, he was very polite to you, and he basically didn't remind you of your first grade mathematics. What is a spread? It is the difference between A and B. Well, let's do the math. 2% minus 0 is 2. But 6% minus 4 is still 2. So a central bank saying we will defend the spread is essentially meaningless. Because if you let interest rates rise, the spread becomes irrelevant. Now, can Germany handle a 4% interest rate on their 2-year? Sure. Can Italy handle 6? Well, no. So you pause for the September, and then you wait for the November, December to move in for the kill. Now, here's the best part about this. The December-November move, it's what's going to happen next week, is basically a trial run. Because if the German and all the European yields don't collapse, bonds don't collapse, you still have the March move in January. Because here's the way the futures contracts work. Futures are financial derivatives that trade every 3 months. So if you have the end of a contract, it's very hard to trade. But if you have a long-term contract, the one expiring in March, you can basically have 2 central bank meetings where Christine Lagarde is going to push interest rates by another %, or even 1.5% up by February, and then you can do all sorts of fun stuff in the derivative market at the beginning of the year. This is an operational level of what my predecessor said when he talked about the macro position and all that. So as traders, everyone who's smart is basically moving into March contract and waiting for the move today. Because today you have the Fed, and Fed's going to say they're going to continue increasing interest rates and be aggressive towards inflation. And with high inflation in Europe, you're going to have a drop in bonds, raising yields. If that doesn't happen, you have the beginning of the January. Now, why was this made possible? Now, why was it for me and for people like me who are apex predators in the financial markets, why was it made possible to such financially crippled Europe to devalue currency by 25%? Because of politicians. It's not because of Istvan, Luigi, Hans, Neven, Ivan, or what's a Spanish name, Rodrigo. It's not because of working people like you that, have a job, work hard. It's because you have people who constantly lie. And when political words do not match the data, predators like me move in for the kill. And it's just money. It's not my fault. Well, it is my fault a little. But remember this sentence, inflation is transitory. Remember, inflation and you cannot be compared. See, this is what happens when you lie. Financial markets punish you. And I've had 3 separate sources from Brussels who have asked a single question. How is it possible that these politicians, Ursula and Charles Michel and all these people, how is it possible that they tell completely different story from the economic data? And I always had the same answer. They were like clones. They think the same way, they say the same things. And this will be the ultimate downfall. So this is the future. There are no more futures. There's only one future. This is what is going to happen. You will have that yield curve will tilt significantly, what my predecessor mentioned. Interest rates will rise. Inflation will continue to rise. Keep in mind, this is a slide from 2 months ago. So this is the old slide from the Hayek Institute. This is not the new slide. ECB will try to defend bond prices with interventions. It has failed. It already illegally and illegitimately did a bond swap where they sold German bonds and bought Italian bonds. They're not allowed to do that. That's not monetary policy. That's becoming a bailout fund. The interest rates will threaten the profitability of banks due to pricing risk. The credit placement of banks will deteriorate, and the fiscal expansion based on growth of social assistance, remember that 200 billion euro German project, how they're going to give money to everyone? That's not a smart fiscal policy. They will create an increase in debt. Now, here's the thing you need to, I will explain this to you very simply. You know why European banks are in a horrible position? And why I and the rest of the predators are betting on their collapse? Because I have a friend. She works in a bank, but that's irrelevant, in Vienna. She got a 20-year mortgage loan at 0.9%, fixed. And everyone in Europe has a fixed loan. Do you know on what is that based on? It is based on an insane notion that banks will never have to pay money for their deposits. So let's assume a price of deposits in Germany goes up by 1%. What amount of loans goes negative income? On your assets, you're making 1%, and your liabilities, you have to pay 2%. But then someone's going to say, but Neven, you can do financial derivatives and you can sell that risk. And I will answer that with a brilliant question. To whom? Because every bank in Europe is going to have exactly the same problem. EU growth in deficit will create a spiral of interest rate growth, which will again lead to the collapse in budget. This is what my predecessor said as austerity. And politicians will present this as a great sacrifice for Europe. Wasn't that John's question? See, isn't it interesting how always when there's trouble, politicians say you have to sacrifice for greater good? And yet when someone, like Stephen, nice guy, says, well, what about that convergence? When my pay, and he's a member of parliament, is going to converge to a European member of parliament pay, They say, well, you ask too much. For years, EU will not be able to create jobs. You already heard that, except in a different sentence. Structural unemployment. Green transition will be intensified with detrimental consequences for economy and cost of life. EU regulation will increase significantly. And here comes the best question. Here comes the best part. They cannot make a mistake. When have you ever heard a politician, European high-level politicians say, okay, I screwed up. This was a bad play. Never. Which means they have to push on with more of the same. More sacrifices, more regulation, more suffering for greater goods and European ideals. Are you having fun? Oh, I want to go back. The political intolerance will increase. Why? Because if we're members of a sovereign nations, a club, then Netherlands shouldn't say to Hungary, leave. That's not a friendly behavior. That's not how nice people behave. There will be a significant drop in standard and loss of competitiveness, not just in the EU, but with the EU globally. And inflation will be significantly above 2%. Now, we're going to do a small break. This is a trick, right? You're all in a bad mood, so let's talk something on the other side of the pond. US, what you have, here's the game plan. Inflation in the United States is done. It's going to fall. The Fed basically doesn't care about inflation anymore. They're raising interest rates only to gather ammunition and credibility for the next recession. So what Fed wants is, with higher interest rates, for banks to be more profitable to lend, to have drop in stock market so that all the YOLO traders go back to work and labor participation to increases. So whatever Fed talks is actually not what they want. They're merely posturing. Now here is what Fed really wants. First, Fed did a great trick. The great trick is that they convinced everyone that QT is irrelevant. No one talks about quantitative tightening. When Powell speaks, he speaks like this. The current labor market is good. But when he talks about quantitative tightening, he speaks like this. The Fed will continue to decrease the balance sheet by $8 billion with quantitative tightening. And the labor market is good and tight. You can watch that on a press conference. He goes over that really fast. He wants to increase the labor participation for the wage pressures to subside, and this is done by decreasing stock market and making constant threats. That's why you have every single Fed meeting, the stock market goes down. But now it's bottoming, so that's it. So what they want is basically make sure that bank lending continues to grow. Now, if you look at the interest rate, if you look at the loan supply, the loan supply in a bank doesn't look like this, the supply curve. It looks like this. It's like a sickle. So if a loan rate is 1%, banks don't want to lend because basically they cannot cover the cost of bad loans and all the other expenses. So you have a threshold where when the interest rates go up, it becomes more profitable for banks to lend. And this is why Fed actually wants to keep the yield curve inverted. Because long-term money is cheaper, implying that investments are going to be cheaper. So inverted yield curve is not signaling a recession. It is basically signaling a fight against inflation, but not necessarily recession. So as long as 5, 10, and 30 yields remain around 4.5%, it's not actually a tight monetary policy in an economic destructive kind of way. But what you heard, and this is a genuine problem, is that GDP economy is cooling off. Now, how Fed is going to counter that is real simple. They're going to stop raising interest rates. And they've already said that. So this is it. They're going to raise interest rates now, in December, and interest rates are over. And they're just going to keep them there for 6 to 8 months, and they're going to start decreasing down. So the inflation and the fight with inflation is, in terms of Fed, the play is done. So what Fed actually wants, ultimately, is to fade back into obscurity. Because if you look at the last 5 years, everyone does is talk about central banks. Central banks are significant for the economy, but they're not the only significant thing. Now, if you remember this, the Americans do, 94 to 98 period, no one talked about Fed. It was just, interest rates, not change 0.25, decrease 25, increase 25. Nobody cared. So once Fed stops increasing interest rates and proceeds with the QT, the drama and, the whole spiel about Fed is going to decrease, and that will actually help the economy. Now, after a brief intermezzo, I will make you feel good. I will tell you how to fix everything. It's not that hard. It is not hard to fix everything. We have all the economic tools we need. We have all the economic knowledge we need. This has already happened like 6 times before. It's not hard to fix things. So we have 2 problems. Problem number 1, sustainability of euro as a currency, and the fiscal debt problem, right? These are only the 2 problems we have. So how do we fix euro? That's real easy. See, euro is not a monetary union. It is a common currency. Now, what's the difference? Well, the difference is you have national central banks. So how do you make euro into a common currency? Well, simple. You destroy the national bank. And you carve up Europe into several currency zones, just like the Fed, but based on the economy, not on nation states. So if you have that one regional central bank covers a portion of France and a portion of Germany, and another regional central bank covers a portion of Germany and a portion of Italy and a portion of France, then the national element in central banking becomes irrelevant. I mean, have you ever heard anyone talk about inflation in Wyoming versus the inflation in Florida? Everyone talks about the US inflation. So if you remove national central bank and you create zones like they have in the US, the Federal Reserve banks, regional banks, but not based on nation states, some nation states, there's no reason to carve up Croatia or Netherlands, which are smaller countries. But if you take France, you split it into 2 or 3 zones, Italy into 2 or 3 zones, there's no more national element in a monetary policy. And you truly get a common currency, which is a monetary union. Instead, what you have right now is something really dangerous. But we'll do that in the epilogue. Second problem. Well, how do you fix a fiscal policy? Well, the solution's already there. What Christine Lagarde did last week, she said that ECB will push banks to repay long-term refinancing operations. There's about 2 trillion of that. No, don't repay that. Subsidize that with government bonds. So instead of banks pay back to the ECB, but then ECB buys back the government bonds. That will alleviate the pressure from nations. They will not be in fiscal problems anymore, but there's got to be a catch. And here's the catch. Smaller government, no pressure, no subsidies, free market, less regulation. And when I say smaller government, Croatia has 550 territorial units. Yeah, that's a correct face. What? I will repeat that again in case someone has ear problems. Croatia has 550 territorial units. Someone knows why. actually, no, everyone knows why. Because that's how you get political corruption. So let's remove 500 territorial units. You get smaller government. And you have fiscal room. It's not hard to do the same in Italy. So, and then you basically do policies that create jobs. It's really easy to know which policies create jobs. It's not actually a PhD in public finance. So, here's the solution for everything. Now, I've come to the end of my lecture, but I have promised an epilogue. Why it will not happen. For those of you who do not know drugs in particular or linguistics, the phrase pipe dream comes from smoking opium. So everything I have proposed is manageable. It's doable. It can be done. Why it will not happen? Why is it a pipe dream? Because the politicians will never say we made a mistake. Even today in Croatia, after yields and interest rates have been rising for a year, Croatian politicians say, when we enter euro, interest rates will go down. No one makes a mistake. I've never heard a Croatian prime minister say, okay, that was a bad play. I've never heard Ursula von der Leyen say, that was a bad play. It was simply a mistake. And there's another thing. I will move into your lecture, and I will tell you two things that are going on right now. The thing number one is, European Union right now is in a state of a financial civil war. You know how I know this? The market tells me that. If you look at the interest rate on Italian 10-year bond, it's 4.5%. If you look at German 10-year bond, it's at 2.1%. But if you look at French 10-year bond, it's 2.5%. That's impossible. If you look at French data, the yield should be higher. Now, why isn't it? It is exactly the same answer to the question, why isn't ECB fighting inflation more aggressively? Well, simple. Let me give you a brief explanation what is a real exchange rate. A real exchange rate is the differential in prices adjusted for inflation. So if two countries are making this chair, and this chair is 100 euros, in Italy, or in, let's say, Germany, this chair last year was 100 euros, now it's 110. But in France, it's only 105. Meaning, as long as France has lower inflation than Germany, France's economy will become more competitive. As it becomes more and more competitive, with weak socialist government in Germany, it will remove German dominance from Europe and take over. And this is the play between Macron and Christine Lagarde. And this is why she isn't raising interest rates. And this is why EU and ECB aren't fighting inflation, because it suits the French. And this is the reason why our prime minister is so friendly with the French prime minister. That's the play. And to end on another note, recently, I've been reading a lot in headlines, which is always a bad sign, that Hungary is in a sovereign debt crisis. However, I pulled these numbers off of trading economics. Well, the unemployment in Hungary is smaller than in Germany and Italy. It has a smaller budget deficit. So it's not a sovereign debt crisis. It's a punishment for disobedience. And the same will happen soon with Poland. The same French banks that are supporting the French yields will simply move in against Hungary. But see, I'm not worried about any of that, because I will make lots and lots of money off of it. You people simply need to ask a question when you come to the ballot. Am I voting the right way? The end.
Not quite the end.
That's quite
Thank you very much. No. Well, I mean, there is so much there, but I'm going to ask you a very simple question about honesty, because that was threaded through all of your remarks, really. And it does seem to me, I want to ask you a two-part question. First of all, it's my impression, am I right, that the level of honesty in the form of public financial statements by chancellors of the exchequer, governors of the bank, used to be far higher than it is today. Why has that happened? And I'm not talking about the legitimate lying where you have to say you're not going to devalue until you actually devalue. But otherwise, I think that this seems to be true. Why has this happened? And secondly, in the light of everything you said, does lying really make long-term sense? Because it seems to me that everybody would be better off, all the market players, if for example, Miss Lagarde were more honest about what she's going to do. First of all, it would restrain her. In other words, she would have fewer. She would be able to say fewer things, but it would have long-term effects. Do you believe that a more honest financial world would be a more successful one, and would it provide better basis for economic life outside the finance sector?
Yes. Remember what happened in 2008? So in 2008, we have had the apocalypse. You know, if Goldman Sachs, Lehman Brothers, Bear Stearns go under, that is the definition of apocalypse. But what happened? Paulson, who was a CEO of Goldman Sachs, had two things. Thing number one is he was primus inter pares. So when he pulled all the people, all the heads, all the CEOs, and he said, okay, this is how we're going to do it, everyone listened to him. He had credibility from his previous job. Then he went out to the White House lawn and he said, these are the three papers. This is the solution to a problem. And US implemented that. So you always, when you had people at a job, you had people who had background in that job or politicians who were leaders. You might disagree with Mitterrand or with Kohl or with Thatcher, but Thatcher believed in something. She had honest belief. Reagan believed in something. Even on the flip side, Brezhnev or Khrushchev, they believed in something. It might have been wrong. But when you listen to politicians today, you have no substance. And if you look at politicians' resume, Ursula von der Leyen was a minister of what? Defense. She was a general before. She served in the army. What was she a minister of before that? So you have these politicians simply exchanging places because it's just a job, a political job. And they live in their own vacuum. And then what happens is, again, you have financial predators that look for money and inadvertently break the system. Because see, I haven't told you about the worst thing about me. Let's say Europe does financially collapse. What about my kid? She's 3 years old. Am I still going to have a kindergarten? Am I going to still have a functioning police? Am I going to still have a functioning courts? So it's all fun and games until the games end. Because even if you are the last standing at the end of apocalypse, you're still in the middle of nuclear wasteland. So in all reality, if there's no one who wishes to be more wrong than me, if everything I've said here and in the Hayek lecture is wrong, I will make a little money, but I'll live. I don't need much. But everyone will be better off. if I'm right, my kid's future is going to be horrible. I don't want that. I don't want that from my 3-year-old or for any of you. But this is where these people are leading you to. This is what honesty is. It's not necessarily sticking to your beliefs no matter what. It's having, as the Spanish would say, cojones, guts, to simply say this was wrong. And we've had this in fiscal policy, in COVID policy, in convergence, in Euro, whatever. Just say you're wrong. Come up with a better solution. Move on. And then if you're constantly wrong, people will not vote for you. That's what democracy is.
Thank you very much indeed. And Professor Pashtor, the stage is finally yours.
Thanks a lot for having me here. Let me tell you that I finished my university lecture almost exactly 3 hours ago, and I have been lecturing since I was 22. And every time when I visit the university, I'm a bit disappointed because our students no longer learn economic history and the history of economic thought. When I attended university, there were some courses under the title of economic history and history of economic thought, but since the turn of the new millennium, they have phased out these courses from the university curricula. And there is an exact reason why I'm saying this. If you love economic history and the history of economic thought like me, you would know that in the US, more than 150 years were needed to make an optimum currency union. And it is quite easy to find papers and authors who say that the US is still not an optimum currency union. And when I'm talking about the Eurozone, and when I'm talking about the common currency, I always tell my students to read an exact paper, and I always tell them that the Eurozone is too young to be successful. There were the teething problems, and there are still problems. And when we have a look at the title for this today's discussion, we could simply put the outgoing or the incoming and the current and the continuing Eurozone crisis as well. Well, there is an exact reason why I start my presentation with this. I usually mention Robert Mundell, who in 1961 wrote an excellent paper on optimum currency unions. And he highlighted the fact that a high level of economic integration is needed in those countries where they want to put a common currency in use. In the European Union, the countries are trading mostly with each other, and Hungary is no exception. Let me tell you that 80% of the Hungarian GDP is produced by the export sector. And when we try to find data on imports per GDP, remain seated, you know, the ratio will be above 80%. And when we put the exports and imports numbers together, and when we divide it by our GDP, we get 170%. So Hungary is an extremely open country and economy. In economics, we call these countries open countries to trade, small and open countries in general. And well, the other countries are open also, but not as open as Slovakia, because Slovakia is, for example, even more open than Hungary. Certain other countries are a bit closed or more closed. France, for example, Italy, Germany, size matters. And when the GDP is larger in general, the ratios related to trade openness may be smaller. So Robert Mundell was highlighted the importance of being open to trade. And I have to say, in case of the European Union, well, this is already there. And Robert Mundell highlighted the importance of the free movement of the factors of production, like labor, for example, capital, goods, and services. And I don't want to mention examples here. I just simply say that the European Union labor markets are still very far from being perfect. It would be interesting to find recent data, but I'm pretty much sure that the number of working age people living and working in other European Union countries is still hovering around 4 or 5%. The data is definitely below 10%. This picture is quite different in the United States. It is quite natural when someone graduates from a Californian university and then takes up a job in Miami or in New York, and after a couple of years, he or she is sent to a third state or a third large American city. Here in the European Union, the labor markets are still rigid, and we can find huge heterogeneities in case of the labor markets. So I highlight again that learning economic history and taking into consideration certain milestones is fundamentally important when understanding our present, our challenges, and our future as well. I am in love with the history of economic thought, and when I'm lecturing, I usually mention Joseph Schumpeter. Around 100 years ago, he highlighted the fact that when we want to conduct a good economic research, we need 3 building blocks. We need theory, we need the theoretical framework, we need economic history, and we need statistics, we need data. When we open book chapters, books and papers, we find data, we find modeling, for example, we can find the recent theoretical framework as well, but the papers related to economic history and the history of economic thought are completely missing. And they are missing from the university programs as well. So there used to be problems in the European Union when the common currency was established, and these problems are still there. And we should not be surprised because we have to learn from the example of the United States, and we still have to wait. And we should not be surprised when certain countries go back to their own currencies, if it happens. We should not be surprised when certain countries leave the European Union. It is too early to say whether the European Union currency will weather the storm or not. And we have to highlight the fact that, yes, we have to learn the previous mistakes made, and we have to learn from the differences in case of the Eurozone countries. What I'm referring to with this, the fiscal policies are quite different. Some economic historians go so far and they say that in some countries they lead hedonistic lifestyles. They consume what they don't have, and taking up credit is never a problem, while in other countries they are extremely tight-fisted and they know what they can buy and they know very well what they cannot buy. So actually, there are fundamental differences in case of the participating countries, and we cannot be surprised by the fact that there are still teething problems. apart from my university experience, I'm going to share a second personal experience with you. I was born around 300 kilometers from Budapest, very close to the Hungarian-Slovakian border. In Slovakia, they introduced the common currency, the euro, already. If I'm not mistaken, they introduced it in 2009. It was quite a long time ago, I have to say. And when I was preparing for my school leaving exam at the secondary technical school, I started watching the business news and I started listening to our politicians. And the first date I can remember was 2006, and this was for the introduction of the euro. Then I continued watching the news and the political debates, and they started mentioning 2008. Later, they jumped to 2010, then 2012. And as far as I can remember, the last year they mentioned was 2014. And now, if you open the business news, they never talk about the introduction of the euro. Instead, they say that having an own central bank and having an own currency is a good option, and there is a need for increasing the competitiveness in Hungary, and we have to learn from the mistakes of those countries where they introduced the euro. And there was an exact reason for mentioning Slovakia. In Slovakia, they have been using the common currency. And well, Slovakia is one of the largest car makers in the world. On a 10,000 or on a per capita basis also, they make many cars, much more cars than they make in, for example, the United States and in the largest car-making countries. And look, in Slovakia, they face the graying of the population. In Slovakia, they have been losing one of the most important competitive advantages, I mean the low wages. And the total factor productivity is coming down. So many eyebrows are raised nowadays, and they say that slowly but steadily they are using their competitiveness. And of course, they are not blackening the euro, but somehow they feel the burden of being part of the Eurozone. In Hungary, we still have our own currency. And when understanding, whether to introduce the euro or not, we have to mention a fundamentally important issue, and we have to make a quick calculation. But first of all, I have to tell you, and not so many experts mention this, the euro has been partly a corporate world project, like the Schengen zone. At the time when they laid the foundations of the euro, the leaders of the corporate world, the European corporations, were knocking on the doors of the European Commission, and they said it would be great for business. When they started laying the foundations of the Schengen zone, the leaders of the largest corporations were knocking on the doors of the European Commission, and they said free movement of labor would be great for us and for the European economy as well. And well, here in Hungary, we are heavily embedded in the German supply chain. There are many assembly line jobs and non-assembly line jobs as well. And let's make a quick calculation now. My university students are dreaming of netting a job, giving them, for example, 600,000 Hungarian forints a month before paying taxes. When the euro is trading at 400, for the company, it means, correct me when I am wrong, 1,500 euros. When the Hungarian forint or the euro is trading at 200, the financial burden on the corporation is different. And I am not saying that corporations are pulling the strings and they are shaping and influencing the exchange rate, but I'm just saying that corporations are not really unhappy about the weaker Hungarian currency. I know very well that in the global value chains, trade is mostly denominated in euros and in American dollars, for example. But when we take into consideration the level of embeddedness of certain German companies, it is quite clear that in many cases they bring their own inputs, they use the cheap labor of the Hungarians or the Slovakians, and they sell the ready-made goods, the outputs, at the other side of the border in Germany or in Asia. So Hungary is heavily engaged in re-exporting. So when talking about the current debate of putting the euro in use or not, we have to reflect on these important issues. And as I have already told you, currently in Hungary, they are not talking about putting the currency, the common currency in use. Instead, they talk about structural transformation, increasing the value added of the Hungarian export sector, increasing the value added of the workers as well. And when the country is competitive enough, as our decision makers say, they may talk about a possible date or a possible year for introducing the common currency, the euro, in Hungary. And well, certain decision makers are going so far that they say that the only competitive advantage of Hungary as of today is the cheap labor. And they say that we have to retain this competitive advantage in the future in the hope of increasing the standards of living. But when we open textbooks and when we open history books and when we want to learn something from the examples of the other countries, it becomes clear that by keeping labor cost low, we will only face the problem of the middle-income countries. So after a time, there will be no room for maneuver in case of developing further and increasing the standard of living. And then going back to the Slovakian example, I have to say that they introduced the euro, they wanted adventures, and now they have adventures because despite the fact that they have relatively low dependency rates. What I mean by that, the number of working age people and the number of old age pensioners, for example. So despite the fact that they have lower levels of dependency rates, they face the aging of the population. They face a demographic crisis also. They are not smart enough in increasing the value added. So to a certain extent, they feel the burden of the common currency, and they have to remain smart when it comes to increasing the competitiveness of the country. My Slovakian colleagues are a bit more pessimistic, and they go so far as they say that, well, the future is not really bright for the Slovakian economy, and it would be quite difficult to find good solutions. And, well, there is one more thing what I want to tell you. Imagine I was only -2 years old when Ronald Reagan entered the office of the US president. And I love the jokes of Ronald Reagan. If you open YouTube, you can find many videos, and Ronald Reagan is telling jokes. And one of my favorites is the following. Two comrades are walking in downtown Moscow, and they are talking about communism. And one of them asks, "What do you think? Have we reached communism? Are we there already?" And the answer is, no, not at all. Things are going to get a lot worse. So we are still not there. And when I'm talking about the Eurozone project or the Euro project, I have to say that there used to be fundamental problems. We just have to remember the paper of Mandel. Certain problems have been solved. Certain problems are still there. And actually, the Eurozone is still far from being an optimum currency area. And no one knows whether we need 150 years or even more. We just clearly observe the fact that there used to be problems and there will be problems in the future as well. Thank you so much.
Thank you. Could I now... Thank you. May I now put my question to you? And it really derives exactly from your final remarks. And it really is this. The problems are that the euro has not, in the whole region, doesn't fulfill Mandel's conditions, and as a result, for example, you don't have, as you have in America, as you said, the natural way of solving them. In other words, not everyone in Portugal, when they're unemployed, wants to go and work in Dusseldorf. At the same time, there is resistance in Germany and in the frugal four countries to turning the European the Eurozone into what do the Germans call it? A benefits, a transfer community. Now, that being the case, it does seem that you could simply divide the Europe. You could either get the Germans to leave, which would possibly be one way, or you could have a southern euro and a northern euro. Those seem to be kind of, to a pragmatic, empirical Anglophone economist, they seem to be the obvious answer. And at the same time, there's an absolute political will not to do anything like that. The crisis surely consists of the fact that the political will is still strong enough. Will it remain strong indefinitely?
Well, when we mention Germany, we again have to go back in time. And when they had their own currency, the Deutsche Mark, by the way, my young university students have no idea about this currency. So when we go back to the 1970s and in the 1980s, we have to remember, or we have to take it into consideration, that as they were selling more and more cars, they were making their own currencies more and more valuable. And as the Deutsche Mark was becoming more and more valuable, they were losing their competitive advantage. It is quite clear. Many other countries have experienced this. Now, in the midst of the energy crisis, from time to time, they highlight the fact that in the Netherlands, they were exporting natural gas, but they turned off those taps and they started buying from the Russians. And they turned off those gas because they faced the problems of the Dutch disease. As they were exporting more, they were losing their own competitiveness. And going back to your question, let me tell you that currently, when there is a common currency and there is not a German type strengthening of the currency or the German currency strengthening, the German economy is benefiting from the Eurozone, and they can export as much as possible without feeling the direct consequences of losing competitiveness. The Germans are in favor of keeping the Eurozone or even extending the Eurozone because they are huge benefiters. They benefit a lot from having this common currency.
Seems to me that is Friedrich List beating Adam Smith as a way of doing things, and the free market being, so to speak, defeated by mercantilism. But there we are. It works for Germany. Now, I must ask, thank you very much.
Thank you very much. Thank you for the very interesting lectures. And this is really a lecture that you go out and you try to analyze because you know that this was very interesting. My question, being here as a Hungarian, I work at Danube Institute. My name is Ákos Bencegász. Sorry for this. I didn't start with this. My question is whether you could advise each of you whether Hungary should enter the Eurozone and when. And the answer can be also never or one specific date, one decade, because we would be really interested in that, I think.
Hello, I would like to ask the gentleman, I'm more confused than at the beginning how the future will look like. What is your opinion of let's say, the Western European banking system? Is it going to fail or is it going to pull through in the next decade? Thank you.
I'd like to know what the professor thinks of Nevin's idea, which would be to have regional banks doing the monetary policy that were disassociated from nation states.
Okay. The stability of banking system is basically not in question because according to the laws, banks can simply confiscate deposits and turn them into capital. So if you really ask about stability, the European bureaucrats have made sure someone else pays that. Now, as for the euro, this is going to sound really weird. But euro has to survive, and it has to enlarge because of a simple thing and a simple reason. Without euro, Europe becomes irrelevant. Because in the 80s and 70s, you basically had G7, which was US and six dwarfs. Now you have G7 and you have BRICS. And if you look at BRICS economy, it's exactly the same like G6 without the US. So if euro doesn't survive, in terms of size, even the largest European economy, Germany, is irrelevant. It's smaller than US, smaller than China, smaller than India. So for Europe to become globally relevant, euro has to survive. But it can only survive under one simple condition. She needs to go. And but not as a person, as a monument to doing everything wrong. I am pro-Euro. While our Prime Minister was writing papers on glorifying Marxism for his senior high school thesis, I wrote my first paper on European Union. I was 13. It's not an issue. But this way, what it's doing to people, to regular Joes, it's just horrible.
Well, yes, I would just address the question on Hungary, if I could. I hosted a panel in Zagreb several years ago, also on Croatia's situation, whether the euro was a good idea or not. And a dear friend of mine and John's, also longtime friend, Robin Harris, he began his talk by saying the real relevant question isn't whether Croatia is ready for the euro, but whether the euro is ready for Croatia. And this instability and these structural weaknesses still remain in the euro, and we see it. It's been kind of a history of emerging crises, one after another. And so this is now what we've been discussing, just the latest euro crisis, and it won't be the last. So yes, Hungary, when you look at the size of the economy and you look at the Eurozone, it looks relatively small, and many of the people in Croatia are arguing that, well, we're so dependent on the Eurozone for our trade that it doesn't make any difference. We're so tightly linked to this area that we might as well join the currency, and there won't be any more exchange costs, and it'll be easier for the tourists to come into Croatia. It's just one and the same currency. But my outlook is more political, and this question of, loss of freedom, the ability to implement your own fiscal and tax policies. What will campaigns in the end be about if you're simply part of this area that's dominated by Germany, and you have to harmonize and you have to abide by the rules that are made elsewhere? The golden rule, I remember one friend telling me in America when I was still quite young. He said, you're young and idealistic, but the golden rule is that he who has the gold makes the rules. He who has the gold makes the rules. And in the real world, that's, I'm afraid, how sometimes this looks. That's maybe a little cynical. But I want to remain, a principled politician. I take sovereignty seriously, and I don't want to be necessarily following the rules made by others. So that's what I would say.
Okay, thank you. So when talking about the introduction of the euro in Hungary, I would say that first we have to take into consideration the trade openness of the country. Let me remind you that it is over 170%. And when we have a look at this number, only we can say that Hungary has a place in the Eurozone. But before introducing the euro, there is a need for a structural transformation. There is a need for increasing the value added. Building on cheap labor only is a kind of partial solution. There is a need for a better solution. And when I was listening to my colleagues, I was debating in my mind what kind of examples to give you, and if you don't mind, I will give you a funny one. My daughter is going to be 2 years old in a couple of months, and she has been playing with Matchbox cars for certain reason. She's not really interested in dolls, and the oldest Matchbox cars are over 50 years old, and when I check those Matchbox cars, made in England is written. And when I check the newer ones, Hong Kong, made in Hong Kong is written, made in Macau is written. And when I check the latest ones, Thailand is written. And look, they no longer produce Matchbox cars in Hong Kong, but Hong Kong is a financial center. Hong Kong is famous for its port facilities and a couple of high value added industries. So they were getting rid of the cheap labor and the cheap labor related and based industries, and retaining the advantage built on cheap labor may be misleading. So I was debating in my mind whether to tell you a date. It would be quite foolish. So there is a need for a structural transformation. And then with the high trade openness level, I would say that there is a place for Hungary in the Eurozone. Going back to the banking related issues, from time to time, I work at the Hungarian Banking Association, and I can read the reports made there. Banks will undergo fundamental changes. They are disrupted by the fintech companies, but banks will be there. They will play an important role in the economy, but it is quite likely that they will get rid of managing payments and transactions. That is not going to remain a core activity for a bank. Think about Revolut. When you have an account, you may pay by your Revolut card or with the help of the application. And the banks don't really care because they don't make much money by just using credit or debit cards. They have more important core activities. And you were asking about the regions, and central banks, and it was quite interesting to hear what you said. And when we were listening to you, I said that Croatia seems to be also a top-down society, because only in top-down societies can there be as many regional units as over 500. I would say that actually, in the hope of getting better economic integration, monetary integration, having, a more transparent, more efficient banking industry, I say, and I completely agree with you, there is no need for regional central banks or state central banks. Because they are only bottlenecks, I say, and hindrances. So in general, getting rid of the top-down characteristics of the societies could be an advantage, and I'm in favor, in this respect, of the free markets and the free will of people. This could be important.
Thank you. I hope Hungary doesn't join the euro. I view Hungary in the same way that I view Vietnam, Cambodia, and the Asian tigers, who, despite success for the last 25 years, have not joined a common currency. Hungary, to my mind, is the equivalent of a Central European tiger, and looking particularly east and somewhat south. And I think the circumstances today further justify that. But also more broadly and more importantly, to my mind, monetary integration cannot succeed without fiscal integration. And history shows that. So what that means is you join the euro, eventually you're going to have to conform to the same tax rate, you're going to have to conform to the same labor laws, you're going to have to conform to all the levels of taxation, and then fiscal spending, how you're going to spend your money. So you lose control over how you're going to spend your money and how much of your money is going to be taken away. And that is a realization that I don't believe is consistent with at least the current government's strategy and direction. So no, I'm not in favor of the foreign joining the euro. And just one last point, I move money over to Hungary for expenses every single month, and I will tell you, fintech platforms, I pay 2.5 forint for every dollar that I move. So that is highly efficient, and I don't believe with already 30 some odd billion dollars of foreign reserves that Hungary has, based on a $200 billion GDP, and covering pretty much all of annual imports coming from the Eurozone. I think Hungary is in a very good shape from that. As far as the bank question is concerned, it is very clear that the banks are very weak in Europe vis-a-vis those in the United States. I would expect and hope there would be some consolidation, as I think we are going to be seeing in Germany, as we perhaps, I don't know what the latest news with Credit Suisse is, but there's plenty of work to do in terms of consolidating the banking industry here. I'm not in a position to comment on Italian banks. I don't know enough about it, but certainly the marketplace believes that they're at risk. If you look at credit default swap pricing, Italian banks are paying higher prices for that than any other EU country bank. The last issue I will pass on. It's not my cup of tea or expertise.
You are all probably familiar with the famous remark of Yogi Berra, who said once, "When you come to a fork in the road, take it." Now, about 30 years ago, I was at a conference in Colorado, and present around the conference table were Helmut Schmidt and Giscard d'Estaing. The topic was the euro, and in the one of the other speakers was and then not very well known Italian economist who later became a very significant figure in the Berlusconi government, Antonio Martino, who unfortunately died earlier this year. Well, there was an argument about the euro. And eventually Helmut Schmidt said, now look, I come to this conference every year, and I always benefit from doing so. And every year we have the American economists around the table telling us that the euro will never work. And every year, Giscard and I have to tell them the euro is going to happen. It's a political necessity, and it's going to happen. And that's that. And then Martino spoke up, and he said, have you ever considered that both may be right? It won't work, but it's going to happen. We came to a fork in the road, and we took it. I'd like, on behalf of you all here, to thank the four speakers for really brilliantly and interesting contributions to the topic, the problem we still have, and point out that every single one of these contributions was completely different to the others. They really were interesting, original, and fascinating. We're very glad to have been the people who were able to bring this discussion to you. Thank you very much indeed.